So let's connect with Mr. Bhargav Dasgupta, Managing Director and CEO of ICICI Lombard, to talk about what is the way forward. Good morning and thank you for joining us. My first question to you is that gross written premium continued to improve in Q4. What are the reasons and what led to the growth in GWP?
So if you see our growth for the quarter, we had a growth of about 19.1% as against the industry growth, which was roughly about 12.6%. So in terms of outperformance, it's been a very good quarter for us from a growth perspective. Now, the segment that we've seen growing has been motor insurance for us, though overall motor insurance growth has been a bit muted. We are seeing good growth in retail health, SME, as also our corporate lines of business. Our sense is going ahead the next year, we should see some of these lines of business continue to grow at between 15 to 20% for us. There are certain lines of business, for example, the tender-driven chunky businesses. For example, crop insurance this year, we didn't have a very high growth. It was a very low single-digit growth. And that is unpredictable because these are tender-driven businesses. It's very difficult to predict how many of them we will win in a bidding process.
Okay. The loss ratio for crop insurance continues to rise. Also, you continue to reduce your exposure to the crop segment. What will be the focus area for FY20?
So as I said, the approach is, similar to what we do as a company. Our approach is that we look at every business in a more sustainable manner. Business has to make sense. And when you find segments which are getting hyper competitive at times and they're driven by tenders, at times you don't win those tenders because we would want to price it in a sensible manner. The other thing that we've seen in the crop insurance side is that the reinsurance costs have hardened tremendously. Not only has pricing become very aggressive, but even the reinsurance costs and the rates have gone very adverse. So we will remain cautious as long as the scenario remains at this level for the next year. The underlying scheme is very positive, but I think it's more of an industry dynamic that we are seeing.
Okay. So did slowing auto sales also impact the motor insurance during the quarter gone by? And are you expecting some improvement in motor insurance led by a pickup in demand of auto sales entering Q1 FY20?
If you see the CM numbers for new vehicle sales, it's single digit for next year. Only CV sales is expected to grow at between 10 to 12%. But however, if you look at the insurance segment, there are three sources of growth for us. One is new vehicle sales. Second is the existing base of vehicles that is uninsured, and the industry estimate is that that number could be as high as 50%. So if you can increase the penetration number for insurance, that itself drives growth for us. And thirdly, for us specifically, there is an opportunity to gain market share from other companies. So if you see even this year, the underlying vehicle sales growth hasn't been very high, but as a company, we've grown our motor insurance business pretty well. I mean, it's more than 20% growth that we've had for this year. So that will continue to remain our objective. And our sense is that I think the second half of the year, we may be more positively surprised than the gloom and doom that we are talking about, even in new vehicle sales. One, because of the base effect. Secondly, I think traditionally we've seen post-elections, vehicle sales do pick up after a short gap. So we are a bit more optimistic about the second half than what we generally see, as a narrative.
Right. So how is it that the persistency ratio for FY19 panned out and the outlook for FY20?
So persistency is not a measure for general insurance because we are anyway selling annual policies. So what we do look at is the growth in the number of policies that we have in aggregate, because each of these policies could be one-year policies. And that number has been pretty smart. We've increased our policy count from slightly less than 24 million to slightly less than 27 million for the year.
Your underwriting losses continue to widen as well. What steps then perhaps being taken there to minimize the loss?
So the combined, which is the measure of underwriting quality, has been very healthy this year. As against about 100.2 last year, this year will end with 98.5% combined ratio. And as long as the combined ratio is below 100, in effect you're creating underwriting value. You may not be able to account for it in the particular quarter because the accounting policy for insurance is that you take the cost of selling insurance upfront, though the income is earned over the policy period. But as long as the combined is below 100, you are effectively creating underwriting value, as I explained. So if you see our underwriting, rather combined ratio for the quarter is 98, while it was 98.5% for the whole year. And our attempt for going ahead will continue to remain the same, in the sense that keeping it around 100 or ideally slightly below 100.
All right. Good luck and thank you for joining us. While we are looking at flows